Most people spend years chasing the wrong target, and it quietly keeps them small. They tell themselves they need more money before they can buy businesses, build a portfolio, or create real wealth, when the truth is that cash is often not the first thing that changes your future. Structure is. Leverage is. Ownership is. And above all, control is. If you understand how to position yourself in a deal, how to separate risk, and how to turn one solid company into a platform for the next one, you can start building something far bigger than your bank balance would suggest. That's the real power behind a holding company, and it's why some of the smartest builders didn't begin with a massive pile of capital. They began by understanding that owning the right piece of the right thing, with the right rights attached to it, can matter far more than looking rich on paper. A holding company at its core is not the business customers see. It usually isn't the restaurant serving meals, the agency running ads, the warehouse shipping orders, or the contractor showing up to the job site. It's the entity sitting above all of that, owning stakes in the businesses that do the actual operating. It collects value from those companies, decides where profits go, protects assets through separation, and creates a system where one good business can help fund the next. And that difference matters early, because if you confuse owning a business with building a holding company, you'll make choices that feel productive but trap you in the day-to-day forever. The first phase is always less glamorous than people want it to be. Before there's a portfolio, before there's a board, before there are polished reports and acquisition announcements, there's usually one messy beginning. Maybe it's a single LLC. Maybe it's a small business you buy from an owner who's exhausted and ready to step back. Maybe it's a company you don't fully pay for upfront, because the seller agrees to finance part of the purchase. That's one of the biggest mindset shifts right there. Your first acquisition does not always require writing one giant check. In many cases, the best early deals are built around trust, capability, and deal terms, not just cash. If you can improve operations, modernize sales, install systems, retain customers, and help the business grow after the owner exits, that contribution has value. Sometimes the seller carries a note. Sometimes part of the price depends on future performance. Sometimes you earn your way into control by bringing skills the current owner no longer has or never had in the first place. That's not some loophole or gimmick. That's real deal making. But if you're going to do it, the structure has to be clean from the start. Your holding company should be separate from the operating business. The operating business should have its own books, accounts, obligations, and legal identity. If you've got partners, the agreement should spell out who gets to decide what, how money moves, what happens in a dispute, and how someone exits if things go sideways. This isn't exciting work, but it's the kind of work that prevents expensive chaos later. A lot of people damage their future because they treat the early stage casually. They pay personal bills from the business account, move money around without documentation, promise equity in conversations and never put it in writing, or ignore the accounting until tax season becomes a panic attack. Then a lender, investor, or buyer shows up later, takes one look under the hood, and sees disorder instead of opportunity. That's why the businesses that scale well often look boring behind the scenes. The books are current. The ownership is documented. The entities are distinct. The numbers make sense. That boring discipline is what creates optionality. Once that first business is stable and throwing off cash, the game changes. Now you have choices. You can extract the profits and upgrade your lifestyle. You can use the cash to reduce debt and strengthen the base. Or you can do what portfolio builders do and ask a more strategic question. Where should this money go to create the highest future return? That's the moment an operator starts becoming an allocator. And this stage, roughly when you move from one business into a small group of businesses, is where the real separation begins between people who own companies and people who build systems. The second acquisition teaches lessons the first one never could, because now you start comparing. You see what broke during integration. You see which assumptions held up and which ones collapsed the second real life got involved. You learn whether your hiring process works across companies, whether your financial reporting is consistent enough to compare performance, whether you actually have a repeatable framework or just got lucky the first time. Most people keep those lessons in their heads. The smarter move is to turn them into a playbook. Write down what you look for in a business. Define what makes a deal attractive, what makes it too risky, and what has to be true before you move forward. Does the company produce dependable cash flow? Is the owner too central to everything? Are a few customers responsible for too much revenue? Will margins survive pressure? Or do they disappear the moment conditions get worse? Those are the questions that save you from buying headaches disguised as opportunities. And as you add companies, you need a platform, not just a collection. That means shared standards across finance, legal, hiring, reporting, and oversight. It means you don't let every company invent its own language for the same metrics. It means somebody can look across the portfolio and tell you with confidence where the cash is, where the risk is, and where the performance is strongest. Without that layer, every new acquisition increases confusion instead of value. A true holding structure works because each additional company becomes easier to understand and support, not harder. Risk separation matters just as much as growth. One operating company should not casually expose the others. If one business has a lawsuit, a bad lease, a contract problem, or a serious downturn, that issue should stay as contained as possible. That only happens when the entities are actually treated as separate in practice, not just on paper. Separate books, separate bank accounts, documented transactions between companies, formal decisions when money moves, and zero laziness about where obligations belong. The legal architecture only protects you if you respect it consistently. And then, as the portfolio gets larger, your role changes again. This is where a lot of builders hit a ceiling without realizing why. The skill set that helps you buy a good business is not the same skill set required to manage a growing portfolio of them. Once you get into a meaningful size range, the question stops being, "Can I find another deal?" and becomes, "Which business deserves the next dollar?" That is a different level of thinking. Capital allocation becomes the job. One company might be reliable but stagnant. Another might need money to grow into something much larger. A third might be consuming attention and resources without earning the right to stay in the portfolio. Mature builders learn to make those calls with discipline, not emotion. They don't keep a business forever just because it was their first win or because they worked hard to acquire it. They look at return on capital, strategic fit, downside risk, management quality, and future potential. Sometimes pruning is the move. Sometimes the smartest decision is to sell a decent company because the capital can work better elsewhere. That's not betrayal. That's stewardship. Governance also has to mature. Early on, informal meetings and a spreadsheet might be enough. At scale, that stops being responsible. You need better reporting, better controls, better advisors, better review rhythms, and in many cases, people in the room who are willing to challenge you when you're too close to the problem. Professional governance isn't corporate theater. It's part of what makes the portfolio durable, financeable, and eventually sellable if you decide to go that route. The larger the platform becomes, the more institutional the expectations get. Lenders want consistent information. Equity partners want visibility and accountability. Sophisticated capital doesn't just underwrite the businesses you own. It underwrites whether you're capable of governing them properly. That's why sloppy structures get punished later, even if they seem manageable in the beginning. And through all of this, one principle keeps showing up in different forms. Every new level demands a new operating system. What works when you own one company breaks when you own 5. What works at 5 falls apart at 20. And what gets you to a few million in value is rarely enough to carry you towards something truly substantial. So if you're serious about building a holding company, stop asking only how to get more money and start asking better questions. What can you control? What can you structure? What risks can you isolate? What standards can you install now that future capital will trust later? What kind of system are you really building beneath the businesses themselves? Because the people who do this well are not just buying companies. They are designing a machine that can own, protect, improve, and compound them over time. And if you can think that way early, you give yourself a chance to build something far more powerful than a single successful business. You build a platform that can outgrow you, outlast you, and create opportunities that don't depend on starting over each time. If you enjoyed this breakdown and want more deep dives on deal structure, acquisitions, capital strategy, and how real holding companies are actually built, make sure to like, comment, and subscribe, and I'll see you in the next one.